Hello, welcome to LCG's preview for the week ahead. I'm going to discuss the, of course, you guessed it, Brexit vote in Parliament, as well as China GDP, global inflation data, and the start of US earnings season. Before that, I'll run down the biggest events in the economic calendar. On Monday, there's China trade balance and foreign direct investment, then Eurozone industrial production. On Tuesday, we have the UK Parliamentary vote on Brexit and Eurozone trade balance. On Wednesday, it's China retail sales and industrial production, German CPI, then UK CPI and PPI, then US retail sales, and the Fed's beige book. On Thursday, it's China Q4 GDP and Eurozone CPI, and then on Friday, it's Japan CPI and industrial production, then UK retail sales, Canada CPI, and US industrial production. Moving on to the top corporate results to watch this week. Daily Sports announces December sales and Citigroup releases its fourth quarter earnings on Monday. Games Workshop releases its first half earnings, and JP Morgan Chase, Wells Fargo and Delta Airlines report Q4 numbers on Tuesday. Bank of America, BlackRock and Goldman Sachs report earnings on Wednesday. American Express, Morgan Stanley, Netflix report Q4 earnings on Thursday. Then finally, Rio Tinto gives a sales update and State Street reports Q4 earnings on Friday. So the second attempt at the parliamentary Brexit vote has come around again. The stakes have gotten higher since the first attempt at this vote, which obviously was delayed. Jeremy Corbyn, the Labour Party leader, has called for a general election should the deal be voted against. His reasoning being to break the deadlock. Thanks to the Grieve Amendment, should Theresa May's deal fail, then the government must submit a plan B in 3 working days after said defeat. So that obviously would make those 3 days pretty important. And so May, in some respects, although there will be heightened uncertainty during those 3 days, perhaps a resolution coming 3 days later may actually minimize some of the damage potentially from this vote, should it be voted against. We're generally expecting this vote to be, should Theresa May's deal be voted for, that should be generally sterling positive, although obviously that would pave the way for exiting the EU, which generally the market doesn't seem to be in favour of, but it would at least avoid the no-deal Brexit, which many are concerned about. Obviously, business in general, Tom Enders at Airbus, for example, asking for an orderly Brexit. And so MPs, it seems unlikely to go along with businesses' cause to vote on this the first time around. So then the question is, what happens if indeed it is defeated as expected? We did kind of mention some of these scenarios the first time around, but still we're at the vote again. This time, hopefully it happens. Let's run through some of those potentials. So one being that, it gets voted against, Theresa May is then able to weather any kind of no confidence votes, etc. from Labour, and goes back to the EU saying, well, listen, guys, obviously this wasn't good enough. We need to, you need to offer us a few more concessions. Maybe enough is done for a second vote to then get passed. That would be quite an ideal scenario, but obviously uncertainty leading up to it. There is the possibility of a second referendum, depending on the options taken by the government here. If they decide that, well, this is the best deal that we could do, we want to avoid a no deal, so let's take this back to the people. Obviously, there could be a second referendum, but that is not official policy at this stage. Obviously, policy can change. If all stays the same after the deal's voted against, that pretty much means a no-deal Brexit. So the UK leaves the EU without any pre-arranged deals, falls onto WTO rules in terms of the trading relationship. If a no-confidence vote succeeds, then we could see a snap election. And obviously that could mean a Jeremy Corbyn government, which is generally fairly market unfriendly, some fairly extreme policies involved there. So that is a distinct possibility. And then finally, we just get a delay to Article 50, which there's increasing noises for at the moment, just to give us more time to argue a better deal with the EU and not have this March 2019 deadline that we currently have. So a lot of Brexit stuff there, so I'm going to try and whiz through the rest of it. Just wanted to mention China GDP. Obviously, the soft data from China have been a big source of concern for markets in the context of global growth. Last time we saw growth of 6.5% year on year from China, so we want to see something in and around that. We can probably expect something around the same for the fourth quarter from China. They're not going gung-ho on stimulus, but some measures have been announced this year. So I think the general expectation being that China's going to try and manage this as a soft landing. The risk is that they're using debt for this infrastructure spending. In our view, it's almost the debt build-up instead of the slower growth that's the bigger risk. And so that's the worry here. Global inflation, obviously just wanted to mention this. There's quite a lot of CPI data out next week. So the theme that's been supporting markets since the first couple of weekdays this year has been particularly the Fed seemingly backtracking on the number of rate hikes it wants to do this year. So more like 2 instead of 4 perhaps. It's able to do that because inflation in the US is about at target, but not very high, not very much above it. And in Japan and the EU, actually inflation's way below target, closer to 1%. So that is reason enough for them to backtrack on plans to start raising interest rates anytime soon. And that could give markets a little bit more breathing space, maybe another leg higher, maybe able to end this correction if we feel like overall central banks aren't trying to do their best to tighten policy in a perhaps weaker growth environment. And last but not least, just wanted to mention US earnings season that kicks off this week. We badly need to see some strong guidance and some expectations exceeding results just for the market to have some chance, particularly the equity market, of recovering from the sharp falls that we had at the end of last year. There is a bit of a sense built into this drop in the stock market that maybe we've seen peak earnings. It is likely that we've seen slower earnings growth, but actually the bar has been dropped somewhat in terms of the market performance of some of these shares, in terms of the earnings performance. So actually easier to beat that lower bar. Banks specifically reporting this week. So some things to consider with the banks. Should in theory be good FICC trading results given the market volatility, generally good for those facilitating the trading. But actually some of these big banks have guided that they expect lower trading volumes than last year. So actually it seems like that's not really been something they've been able to capitalize on. In general, this was more of a 2018 theme that the US economy was strong and interest rates were rising. That's a good environment for banks. What's changed this year somewhat is that the yield curve is inverted at some parts. And so that brings on the bigger prospect of recession. And we've already started to see that loan growth has stalled out somewhat. That makes sense, obviously, as interest rates go up, less people want a loan. And the banks, given the prospects for recession, perhaps are going to start increasing loan loss provisions, and that'll eat into their profit margins as well. So in general, investors thinking about the timing of the next recession, and banks maybe not the place you want to be if indeed you see a recession around the corner. For what it's worth, Warren Buffett has been buying up big banks by the bucket load. So that is always worth considering. Thank you very much for watching. Good luck trading this week. And if you want to see these videos as soon as they're released, please follow LCG on YouTube and social media.